My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Deepak Shenoy, founder and CEO of a firm that runs money in India, has a book as well. Deepak, first time you and I are speaking, introduce yourself to the audience and to me. Who are you? How did you get interested in markets? And how is India looking recently?
Thanks, Michael. And so, quick history about me. I mean, I'm actually a computer engineer. So, I started in the tech world, and my first company, we built accounting software packages, largely for companies in India and around the world. And then got interested enough in finance to then go down the investment route, set up an algo trading hedge fund in India in 2007, 2008. And since then, I started Capital Mind as a more retail oriented investment research service initially, and eventually we got around to managing money. We manage about 1,000 crore rupees, which is about $120 million. Um, Very small by US standards, but okay by kind of Indian standards. So we manage that money in investing in Indian markets primarily. Indians have a little more uh, complicated as a path if you want to invest outside of India. So most of our investments, in fact, all of the money we manage is invested inside India. And my journey has largely been coming from the quantitative world. So we look at data a lot to make decisions. We even run a quantitative strategy, which is based on the momentum factor, and we use momentum to kind of build portfolios in the Indian markets. And that's done fairly well in the last few years. It's only been about 3 years now, but even the actual performance and the past performance has been quite reasonably decent over the last few years. Of course, the last 2 years have been very kind to Indian markets, especially, and I can tell you a little more about the Indian market. The Indian market's actually done very well in comparison, in rupee terms, in comparison with. Uh, Say the US markets, because the US markets are, I think, down 20, we're down about 20-25%. The NASDAQ was down about 35. The Indian markets were, I think, down at a max. They were only about 15 or 16% down, and right now they're about less than 10% down from the all-time highs last year. So, relatively speaking, the markets have been good. A quick note about India: we're a relatively small stock market. Our total stock market, market cap would probably be around, I think, around $3 trillion. Relatively speaking, though, the volumes that trade on the Indian markets on a daily basis are probably of the order of $8 to $9 billion a day, which is compared to the US markets a fraction of what trades there. Largest participants in our markets, one of the largest participants on daily trading in our markets are actually retail investors. So they tend to be about 33 to 34% of daily trading volumes. The rest are by institutional players, including brokers, mutual funds and hedge funds, and foreign institutional investors who are actually categorized differently. So the single largest block happens to be retail investors. So it's a very retail oriented market as well. Uh, the economy itself has been doing relatively well. Now, what's happened in the last few years has been that India, as much as COVID has hurt us, there hasn't been so much in terms of fiscal support to the Indian, economy and the population. So, in comparison, we don't have that much inflation right now as compared to most of the West and the US. So, India's inflation is actually 7.4%, and it's been around that for a while. While I think the US is at 8 point something, and it's a little bit higher in some of the other countries. But what's happened because of this is, we don't it's not a lot of the stuff that's hurting in terms of interest rates in the West. The sudden spike in interest rates has not been quite that spiky for us, although we have seen interest rates go up. So our interest rates were already relatively high. We're at about 4.5%. Now we've gone to 6%. which isn't as much in comparison with the rest. So currently, the markets are in a very interesting phase where we seem to have decoupled from the damage in most of the world markets. I think next to Indonesia, it's the best performing market in 2022. I'll just leave it there because I've talked a lot, so I'll
No, no,
let you take it.
and I'm curious in that transition of your career from the technical engineering side to the investment management side. What were some of the things that you would look to educate yourself? In other words, what kind of resources are available for investors in India? I mean, obviously, one can go the route of like a CFA charter or something that's more standardized, but what kind of educational resources are available in India relative to maybe other parts of the world?
Oh yeah, so we have like the CFA charter. With there's an accountancy course here called the CA course, which is more on the accounting end, but that's one piece. Now there are a lot more educational courses, including chartered financial professional. You even have a technical analyst kind of certifications that also have come up. When I started out, it wasn't so much. They were only broad MBA courses, which kind of gave you a grounding into some of the things. Derivatives, for instance, India is one of the largest single stock options markets in the world. So a lot of trading happens on single stock options, and most of that trading happens by retail investors as well. And because of that, the amount of education that's actually started to come out is quite dramatic, because you both have tools that help you navigate the option markets, and also you also have tools that help you. You also have books and courses and certifications around derivatives now. But it wasn't so easy early on, because we were pretty much, 2004 is when derivatives actually started making any meaningful sense in India. And from then, it's gone about, I think, maybe 500x in terms of volumes since then. So a lot of the resources and the education had to come up along the way. So now there are about 10 different certification courses that help you understand the derivatives market. India is one of the highest margined markets in the world. So a lot of the, like for instance, you cannot go naked short in India the way you can in the US. There are lots of rules against it. So what happens over here is that a lot of the derivatives market is limited by a lot of rules that the Indian equivalent of SEC, which is called SEBI, the Securities and Exchange Board of India. SEBI actually puts in a lot of rules that restrict the amount of leverage that is possible. So a lot of the things that happened in the US, like what happened to brokers when the GameStop saga happened, can't happen here, simply because they would have not allowed those trades to have happened a lot earlier than they did. And we don't have the same kind of market maker complexities that kind of bring that leverage to the fore. So there's that. That part of the system has actually evolved because India had a lot of issues with this in the past, and therefore the rules have been set in now. But my journey itself was, you had to learn, because you didn't have so much in terms of both internet resources. In fact, I learned a lot about options from US market trading sites. And then we figured out that in India, things are very, very different. So we had to modify a lot of the tooling and a lot of the way options were traded to suit Indian dynamics. So a lot of trading strategies that work very well in India will probably not work at all in the US option markets. And what works very well in the US option markets don't work very well here. So this is a process of discovery that happened over, a long period of time. Of course, now a fund manager, as we're called a portfolio management service. This is like a managed account service in the US. We are not allowed to easily take derivative exposure because it involves leverage, and we can't take any leverage in our products. But it's still a very, very big market. So part of our research goes towards that as well.
Yeah, that is, and this is partly me educating myself on this and listening to you. I didn't realize that there are more regulatory limits to leverage when it comes to India's stock market than our markets here in the states. And I would actually argue, if that's the case, that oddly enough makes India more, to use a Nassim Taleb term, anti-fragile. right? Because oftentimes the tail risks come from leverage, and if you limit leverage, you're less likely to have the real nasty and sharp declines. And obviously, India's had many sharp declines, like just like everybody else, but that leverage component is an important one to fragility.
I'd say yes, but there are disadvantages of it as well, because when you don't allow a lot of leverage to happen, a lot of good things don't happen to you. So, sometimes the good offsets the bad. So it isn't altogether roses, but yes, of course they've managed to do it, and I think it's fair because, for instance, you can't have 140% short interest in a stock in India. It just won't happen because everything gets stopped out at about 20%. So you can't have more stock short than than stock that has been issued in by the company in the first place, which is astounding to me because it doesn't make any logical sense, but it was possible in the US. So that part maybe was an extreme form of leverage, but then having only 20% short allowed is also a little too little, if you ask me. So you know you have to balance it out perhaps, but yeah, I mean, there's good parts about this controlling leverage thing and there's bad parts about it, and I think right now, because the world seems to be in turmoil, it just seems that we're doing well because of
Why
it.
is it that so much of the trading is driven by retail, which you alluded to many times as sort of the largest block of volume? Is it a function of there not being as robust a financial advisor community in India? Is it a function of easier access or even just smaller account sizes? Talk about why you think that that's the case.
So multiple things. I think you got. For instance, the institutional framework itself has taken a lot of time to set up. For the longest time, ETFs weren't very popular. So exchange traded funds, which are created largely by by companies that run mutual funds in India, they didn't pay too much attention to it, and only now are you seeing a lot of ETFs come about which track indexes. So in a way, that part of the whole retail investing framework, which would have gone through ETFs, would sometimes comes directly into the market. Secondly, retail participants have traditionally had a lot more capability for leverage. Individual leverage has always been much higher because brokers offer much higher margined trade possibilities to retail investors compared to institutional investors, including like us. We are a PMS, a portfolio management service. We can't use any leverage. But for instance, if you bring in, let's say, the equivalent of say $10,000 as a retail investor, they might, and in the earlier times, they could allow you to trade up to $1 million worth on the same day. So you could do intraday trading, and this was what drove a lot of retail trading. People used and sometimes abused this leverage to build huge trading volumes, which is also why there's a difference between what is intraday traded and what is actually delivered at the end of the day. Many stocks you might find only 10 to 20% of the volume is delivered at the end of the day, and the remaining 80% is traded in intraday, and this is largely by retail participants. This also means that retail participants don't end up holding a lot of stock, they just trade it in and out. So if you look at the whole Indian stock market, kind of holdings of all the large companies or all the companies in India, only about 10% is held by retail investors. Around half is held by the founders of the companies. We have a very high founder component compared to the rest of the world. So 50% of all the total public stock is actually held by the founders of the companies themselves, and 10% is by retail investors. Around 15 or percent is by domestic institutions, including mutual funds and so on, and around 25%, the remaining 25% is held by foreign institutional investors. This must have come down in the last maybe 6 or 8 months, but that's roughly the framework. So retail investors don't end up holding a lot of stock; they just end up trading a lot of it because they get a lot more leverage. There's also the fact that um, the number of players that were allowed to actually do managed accounts and so on, there's a lot of restrictions on how they can operate. So um, uh, as a PMS, for instance, I cannot buy and sell a stock on the same day. I have to actually buy it, and only when it is settled, which is 2 days later, can I sell the stock? But a retail investor does not have the same restriction, so they can buy today and sell tomorrow, and that's perfectly fine. So these restrictions make it easier for retail investors to trade compared to institutions. So like you were saying, sometimes the rules they work against us, and perhaps that's why the institutional market hasn't grown quite as much. Uh, to just give you an example of how skewed it is, there is a India's largest mutual fund, the one that invests in the top 50 stocks. It's called the Nifty 50, an ETF that invests in the Nifty 50. It has assets of around, I think, about 25 to $25 billion right now. The next highest assets owned by any mutual fund is probably of the order of $8 billion. So it's substantially lower. But one US ETF, I think it's called Indy or Ind A or something like that, which owns only Indian stocks, that has more assets under management converted to rupees than all Indian mutual funds except one. So, relatively speaking, the mutual fund market is really tiny. It's growing, but it's really tiny in comparison with anything that you see in the US or in the West, actually. So, in a way, our institutions are still developing. So, you're getting, I think retail investors will eventually become a much smaller part of the ecosystem. They used to be 50%, now they're 33%. They'll probably, India, I mean, like Asia, I think even Korea has a very large retail investor component. So India will always have that, at least 20-25% of daily volumes being driven by retail. I just don't know if it'll go down to the 1 or 2% levels. Lastly, it's algo trading's a relatively new phenomenon here, and again, it's also severely restricted. So, the kind of algorithmic trades or high frequency trading that happens in the US does not happen here. All trades have to be cleared at the exchange level. So, you can't have payment for order flow like it happens in the US in any meaningful way. We have an equivalent, but it's not, it's nowhere as popular. So, given that, I think given the high frequency trades, because they don't happen across, in the same way, we've not had that kind of institutional volumes come in and take over the markets either.
So I find this whole thing actually fascinating. This point that you mentioned about 80% is not settled, so it's basically a bunch of effectively day trading that's happening. I'm curious, what do you? Why is that? Is it that there's some aspect culturally of India where there's a more of a gambling mentality, which I would argue is what day trading more often is? Is it a function of less education, again, smaller or larger account sizes? Why is it that you have so much short termism?
Oh yeah, it's probably a combination. There's a lot of account sizes are really small. So we have roughly 100 million trading accounts in India. But then the number of active traders in that, number of people actually doing trades on a regular basis is a fraction of it. It's probably half a million people that are actually, or maybe a million people that are active on any given day. And a lot of them just come into the market to gamble, to do what is called jobbing or trading. They just do day trades and earn some money. Earlier, there used to be people who used to just arbitrage between two exchanges using two terminals of each individual exchange. And now, of course, much of that has gone algorithmic. But even now, there are people who will play short term trades in the markets simply based on tips by people who just say, well, you should buy the stock and you should buy something else and sell it for this much in a day and so on. And because of the leverage they're afforded by their brokers, sometimes which used to be 100 is to 1, now I think it's gone down to maybe 5 to 1. So if you put in $100, you get $500 worth of stock that you can buy and sell. So uh, you might, you know, you might end up making a significantly higher return. If so, it's a bit of a gambling thing as well. But there's also the fact that uh, a lot of players, uh, you know, they don't have the capital to sustain. So if you're on borrowed capital, you're trading on margin, you have to square off your trade by the end of the day because you brought in so little capital by yourself. So account sizes are small. We don't have, for instance, a 401k equivalent here. So we can't put anything into a retirement account and trade, use that money to trade directly into the stock markets. Our equivalent of a 401k is more like a pension plan. You have to choose a pension provider who will actually then go and buy stocks on the exchange themselves. So you can't determine which stocks are bought in your own retirement account. You just have to give them the money and let them manage it. So you don't have the 401k equivalent. So that, I think, is one of the big things that drove a lot of uh, long termism into the US markets as well. And that came in the 80s, I think. And we still don't have one equivalent there. So, and of course, to a very large extent, India didn't have the population that had enough money to play. To invest in stocks for the longest time. Most Indian savings would go into real estate and gold. It's only in the last about 8 or 9 years that things have changed quite dramatically. Um, and real estate and gold are less in favor, and stocks are more in favor. In fact, for the last 1 year, one of the reasons why the Indian stock markets have stood out, and not fallen quite as much is because Indian domestic investors have been putting money into stocks literally every month. So much so that they've overridden the global funds that have taken out money from Indian stocks. And I think about $25 billion moved out of Indian stocks in the last 1 year or so. And Indian investors have actually, this is unprecedented. They've never done something like this in the past. They've actually put in just about as much money into mutual funds, which then have gone on to buy stocks, apart from buying stocks themselves, which is probably what supported the market from falling too much in the first place. So it's probably the early stages of being seeing some long termism, but nowhere close to what the US is.
Yeah, very very interesting. Okay, so we talk about leverage from a trading investing perspective for those in India in their local markets. Talk about leverage for the companies themselves among these large, mid, and small cap companies. Maybe sort of describing sort of the structure of the India stock market in terms of the concentration of large versus small cap companies, average market cap. Just educate the audience a little bit here.
Cool. Okay. So I think I don't have exact numbers here, but the top 50 stocks are roughly 85% of India's total market cap. And the top 100 are about 92%, I think, or 91% of the total market cap of the Indian company. So what you would call an S&P 500 would effectively be India's top 50 or top 100. We have about 2,000 companies listed, but again, volumes, if you look at the first 50 companies, the highest would be, well, about $200 billion, I think. I mean, I don't have the exact numbers. And then the smallest among the top 50 is probably of the order of $10 billion. So $10 billion in the US would be like a mid cap or a small cap, but 10 billion in India would actually make it one of the top 50 companies in India. Um, the next 50 companies, which would make the rest of the 100, would probably be again of the order maybe about between 6 billion to 10 billion. And the mid cap universe, which is what we call India's stocks between 100 and stock number 250 in terms of market capitalization, would be between 2 and 6 billion dollars, and less than $2 billion are small cap. So it's relatively a smaller size of the markets. And a lot of these companies, what's happened to us is some of the largest companies in India have been companies that have very little debt or no debt, similar to the US perhaps, because Amazon, I think Apple has only uh, debt for the purpose of keeping the cash outside the US, but otherwise they're not actually, they're debt free if you include their cash. Google's a debt free company, and so is Facebook and a bunch of others. India's top IT services companies are all debt free. They're very cash rich. a TCS, Infosys, Wipro, and the like. A lot of car manufacturers in India have no debt on their own books, uh, and therefore a lot of the leverage in our top 50 companies is just by financial entities like banks or non-banking, what you might call a shadow bank in the US, non-banking lending entity. A significant number of oil players also have very little debt, or very little net debt, because the oil prices shooting up in the last few years has kind of helped them reduce their debt substantially. So one thing that happened in the 2012 to 2015 kind of time frame was an introduction of a bankruptcy act. India did not have one, so you couldn't actually declare bankruptcy. So, to a certain extent, when a company borrowed too much, there was no, there was no way to say, I'll get rid of some of this debt. So you had to make a deal with every single bank that had given you a loan and say, well, can you write off some of this, please? Because I'm not going to survive if that doesn't happen, and so on. There was no framework to actually resolve a company. And this resolution framework is called the Indian Bankruptcy Code, or IBC, that came about in the last decade. And because that came about, banks were able to say, well, if you don't pay us, we're going to take your company, we're going to sell it to someone else. And that someone else is going to bid for the company in this bankruptcy framework, and then take it to the next level. Take over the company, and pay us back whatever they can. This framework resulted in a lot of companies uh, who were over leveraged being resolved, being sold to other players, and so on. So the the idea earlier was that companies would load themselves up with debt that they couldn't pay back, and then expect the banks to write off some of those loans when they couldn't pay back. Now that the Bankruptcy Act or the Bankruptcy Code came into place, the same managements of those companies realize that if they default and they don't pay back their debt, the banks are going to take their companies and sell them to someone else. That fear has brought about a large amount of consolidation. So banks actually were paid back most of their loans and reduced a lot of the lending to corporate entities between 2015 and 2021. So corporate debt actually stayed flat through this time. It was mostly retail loans that increased during this time. So leverage from a company perspective has actually come down. It's only now in the last maybe 6 or 8 months that you're seeing a resumption of leverage being taken by the corporate sector. Even the banking sector has been severely leveraged. So a lot of banks were in deep trouble again because they couldn't get paid by in India. Corporate borrowers actually don't borrow from the bond market, they borrow directly from banks. So that puts the banks under stress where the corporates can't pay. So the banking system also went into a massive stress sector. The banking sector is dominated by public sector banks, in the sense banks owned by the government. So they used to be about 70, they used to be about 80%, now they're about 65% of the banking system. But these public sector lenders were the ones that were most in trouble. They consolidated, they merged a bunch of those banks together. And over the last few years, even those banks have gotten some more strength. So, in terms of leverage, the overall system is far lower levered than it was in, say, 2010 or 2011. So, we are unlikely to have a similar kind of a banking crisis. I think the US has done the same thing. It's Europe that seems to have gone bonkers on leverage, and Japan. I mean, that's a different story. But India uh, has actually managed to cut down leverage, mostly because everybody was in trouble, so they had to fix things.
Deepak, you mentioned briefly there oil companies in India, and here in the West, that's been talked about a lot as having a secular trend higher because of underinvestment. I'm curious to hear your thoughts on oil and gas, any kind of exploration companies in India. How do they look fundamentally? Is the underinvestment dynamic as severe there as it is in the States? Talk about that for a little bit of time here.
Oh yeah, of course. We don't have too much onshore gas in India, so or oil and gas in India. So whatever little that is done is actually there's a big, large public sector company called ONGC, Oil and Natural Gas Corporation. They actually own have a bunch of oil wells in offshore in India on the seas. They also have partnered with a bunch of other companies, some including Rosneft in Russia, including in Venezuela, including a bunch of other places. So there's most of our oil exploration pieces terribly underinvested also because we don't have too much natural gas or oil in India itself. So whatever little is there, there's another company called Reliance. It's a private sector company that has a bunch of oil exploration blocks. There have been a lot of blocks and a lot of exploration that's happened, but because it's either deep sea or in very inhospitable land areas, it costs way too much to uh, try and get oil out of India. To tell you, the south of India, which is the V-shaped peninsula, that entire thing is actually a plateau. So to go down to any meaningful depth, you actually have to break through a significant amount of rock, and that's just inefficient and just way too expensive. Even if there was a lot of oil down there, it would be too expensive to drill and take out. So there's not that much in terms of investment that happened in India. But oil and gas companies in India largely we import crude. Crude is our largest import. So much so that it makes up for most of the current account deficit in India. So crude oil, we import crude oil. We also have a large amount of refining capacity. So a lot of private sector and public sector companies have built refining capacities. They convert into petrochemicals and diesel and petrol and so on. And uh, many of the oil companies then, of course, retail that through networks in fuel networks in India. We don't have that much in terms of oil exploration uh, in a meaningful way. And gas, we have barely any gas. In fact, right now, what's happening seems to be that some of our companies who have long-term contracts for supply of gas from some sources outside of India, uh, they're actually seeing the contracts getting broken and the penalties being paid because gas prices went so high that it was actually cheaper to pay the penalty to break the contract rather than deliver the gas in India. So it's been a weird kind of a situation where you thought you had gas supplies locked in, and suddenly you find out that you don't have any gas, and then a lot of plants can't operate. So uh, but again, India is not so dependent on natural gas itself. Most of our power plants are coal, uh, and there's a lot of coal available in India. So that part, I know it's not green and all that stuff, but at least it keeps the lights on.
Yeah, no, that's an interesting point. You mentioned that you do a lot of with the portfolio side focus on momentum. What sectors in India's markets are having the most and strongest momentum? I mean, yeah, obviously energy has been a big one here in the states, but is it similar in India? Are there other areas which are showing renewed strength? Perhaps talk about some of the momentum dynamics you're seeing.
So momentum, of course, you've got both short-term and long-term momentum. Right now, it seems to be in the banking sector. Banking has finally seen credit growth after about 8 to 9 years. So both the stock prices and in terms of credit growth, we're seeing the largest amount of momentum in banks. And right now, as results are coming in, because the September quarter results are just starting to trickle in, almost all banks seem to be doing extremely well um, on results, and the stock prices also have been doing reasonably well. There have been different pockets of interest. Last year, for instance, information technology or IT services did really well. Um, Earlier this year, pharmaceuticals. Uh, those companies, pharmaceutical companies, did really well. Most of them, of course, contract manufacturers, or they might make generics, which are sold into the US and in Europe and so on. But there's also local uh, drug manufacturers who did well in the early part of this year. Recently, it's been banks that have kind of taken over, and auto. So autos had about a 5 year you know, and 5 years of nothingness in the auto space, India sells less cars a month than France, I think, roughly. Uh, and we're terribly under, you know, penetrated in the, four wheeler, or a passenger car territory. But still, sales have been, going down or have not increased in a major pace. It's only this year, post after COVID, there's been a lot of revenge buying, to the extent that some cars, if you want to buy a car today, it'll take you a year before uh, the car will be delivered to you, because there's so much demand. So car manufacturers have started to see a lot of momentum in stock prices as well. Um, I think that's primarily the large sectors. There are a bunch of others as well. The electric vehicle, uh, you know, ecosystem has been seeing a lot of interest. So that part, as new capacity seems to be coming on board, and as new deals are being announced, some of those companies are doing really well. We don't have a Tesla equivalent yet, but we have some, some of the local manufacturers. India has a very interesting dynamic. We actually have a lot of car manufacturers in India, but that's also because India puts 100% duty on any car that's manufactured outside India and brought in here. So that's just to protect the Indian industry itself. But that also means that India has had to build a lot of capacity and research, and some of the research is starting to show in some of the manufacturers in the electric areas. Um, and Of course, they're really small cars relative to what you might see in the US or in Germany or in Europe. But that's another part of it that's coming around. So momentum wise, things change now probably on a monthly basis. But as of now, I would say, those are the large sectors that are seeing some momentum. Um, there is actually downward. I mean, the number of stocks showing momentum are more in the small and mid cap areas now than in the large cap areas. That's also because the market sentiment has been very weak in the last maybe 4 or 5 months. It's only now starting to come back to life. So you're seeing. Uh, uh, and as results come in, we're actually seeing downward momentum more than upward momentum. So when a company announces good results, sometimes the stock falls 5 to 10%, especially if it's a large cap stock. So there is some kind of downward momentum more than there is upward momentum in the large caps.
You mentioned manufacturing. I'm curious to hear more about your thoughts on manufacturing in India in the context of ongoing tensions with China, which probably are not going to abate anytime soon. Talk us through how geopolitical risks with the relationships that many countries have with China, how that benefits or maybe doesn't benefit India.
Okay, so this is weird because I guess India is one of the largest non-crude imports that India does is from China. So we actually are China is one of our biggest trade partners, but there are also geopolitical tensions around the borders, and there fights that happen at the border and so on. So India has this geopolitical risk of on one side there's Pakistan, on the other side there's China, and there's always some kind of tension going on either side. But trade has largely been independent of it. However, recently this COVID issues in China, especially their zero COVID policy and the closing of ports and all that stuff, that kind of did two things. First, because India imported so much from China, there was a big problem because our companies which manufactured pretty much anything, there would be some kind of input from China. We don't, for instance, make LED bulbs. We just import them from China, and kind of Indian manufacturers put their label on it and then sell it. So they're more traders than manufacturers. So they had to build a lot of that, some of that capacity uh, inside of India, and because of that, there was more capex that happened in the last 2 or 3 years. India uh, provided more incentives to shift more manufacturing to India. So there's something called a a production linked incentive that allows companies in India to now, if they manufacture in India, they, based on their production, they get a little bit of a subsidy. This is to avoid over dependence on China in a lot of ways, and that's not because of the geopolitical tension. It's just because China is not sending stuff out. Their stuff is getting delayed for sometimes weeks and months. But also, geopolitically speaking, I think the world has come to an understanding that you need to have a lot more uh, manufacturing inside your country so you can protect yourself when things go bad. So there is that understanding as well. But the benefit also that comes to India is because not only are Indian companies seeing this as a risk to depend too much on China, it's also worldwide that everybody is looking at this and saying we can't have so much of our dependence on China. Can we find alternative sources for some of the stuff that we use? So whether it is APIs in the pharma space, whether it is core chemicals or intermediate chemicals, whether it is auto parts. If you only depend on China and China has at some point uh, a stranglehold on that space, it hurts uh, potential manufacturing deals for everybody else in the world. So everybody's trying to diversify, and part of that diversification happens to come to India right now. Is it's coming as we speak, and so more of uh, more of our companies are getting manufacturing setups. So it's not just publicly listed companies; it's also companies that are listed in the US or Europe that are setting up new plants in India. So there's a bit of that that's actually starting to move. It's an early part of this ecosystem. So because manufacturing, setting up and moving things around takes at least a 4 or 5 year cycle. And I'd say it's more like a 10-year cycle. So unless this continues for another 4 or 5 years, we're not going to see the biggest benefit of it come to the Indian economy. And I think it's still early days, but like car manufacturing is largely, at least for the most part, most cars that are sold in India are made in India. It isn't so in most of the other industries. So that part, the equation is very skewed. It's sometimes 90-95% imports. So that's probably going to get substituted over the next maybe 3 or 4 years. India is a very large consumption economy. So we're the only country among the BRIC who actually runs a current account deficit. And we're one of the largest consumption economies outside of China and the US. So, because of that, you know, just changing the import substitution list from 95% imports to even 75% imports, that will change the game quite substantially. We're seeing this happen, but again, early days.
Yeah, and that consumption point's an important one, right? Because I think that's always been the argument broadly for emerging markets, right? As more and more wealth is created, people want new and better things. They want to enjoy the good life, right? So they spend more on things that would otherwise be more expensive and hopefully have more quality. And a part of that, obviously, is also around food, right? So I'm given the volatility in the agriculture space, Deepak. I'm curious, um, how do you think about volatility when it comes to areas like wheat or other core staples in one's diet? Has that been a source of stress for uh, Indian consumers? Just talk about how food prices have impacted spending power.
Oh, this is interesting because India's food inflation has been relatively low. India produces most of the food that it eats, so it ends up. So, for instance, a lot of the staple food like wheat and rice is produced by India. We are one of the largest producers in the world. In fact, we have a massive surplus. And one of the things that happened earlier this year was an interesting story there. In Because wheat prices in the world went up so much. Some of the Indian wheat producers said instead of selling it in India, why don't we just export it? And then India, because the government, because they saw this and they said, okay, prices in India will rise, it'll give, there'll be a lot of inflation and the poorer people will not be able to afford food. They actually said they banned the exports of wheat. So that also happens where the government comes in and says, well, you're not allowed to export this, even if you get a better price outside. So, in that context, domestically at least, we've not felt the pinch too much of food inflation going too high. Certain elements of uh, 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 imported items of food, they've gone up quite substantially, but then there's a very small amount of population that actually consumes those. That might be anything from imported chocolates to imported um, milk products and so on, which are relatively higher end consumption. Core milk consumption is all serviced from domestic sources, and that hasn't seen a significant increase in price, other than in pockets. So we had actually much higher inflation last year. Maybe early, we had vegetable inflation because of a problem in production and supply. And over the last year or so, we've actually narrowed things down. In fact, food inflation is likely to go down substantially in the next 2 months, because when winter comes in, the harvest kind of comes into the markets, and usually by December, prices of food fall quite dramatically. So we're expecting now inflation to actually come down in the next few months rather than uh, go up in the food territory. But I see how this affects discretionary spending in the US. Here, it's not so much as an impact. However, India is a relatively poor country. So I think um, for the people who do have you know discretionary income that gives them the ability to spend in a discretionary way, for them food is such a small part of their overall basket that it won't matter at all. In fact, uh, for India, food is a I mean for the people who make reasonable amounts of money, that's probably just about 10% of India's population. So for 1.4 billion, there's probably just about 150 million people who actually make incomes of the kind that gives them a lot of discretionary income to be able to spend in the first place. That's mostly the population that you might see on Twitter or Facebook uh, or something like that. Although we have 1.4 billion people, but yes, having said that, this the inflation that you see affects the poor. So the government will not allow food prices to go out of control. That's what at least they've learned from their past, political uh, uh, whiplash or throwbacks that have come to them, that they shouldn't let food prices go out of hand.
All right, maybe for the remaining 10 minutes or so, again, everybody here, please make sure you follow Deepak. I know most of my conversations tend to focus on U.S. investing, but I think this is actually a super interesting conversation. It's good to just help people think more broadly about where to put capital at risk, and different opportunities outside of the home bias that everybody naturally has. You wrote a book, Money Wise: Timeless Lessons on Building Wealth. I love the cover, which which basically shows two letters, where it's either fake or fact, and there's a lot of, I think, fake things that people refer to when it comes to investing. And I don't mean necessarily fake from the standpoint of intentionally being fake, but a lot of things you can argue don't really matter or have predictive power that people will say confidently, typically does. Walk us through a little bit. First of all, why did you write the book? And what are some of those timeless lessons that, whether you're an investor in India or an investor in the US or China or anywhere in the world, that what are some of those lessons that people should focus most on?
Okay, yeah. First, my motivation for writing the book was so we manage since we manage money. Our problem, of course, is that we can't. We have a certain minimum limit. It's about 100, effectively a little bit less than $100,000, maybe, or that you have to have before we can manage your money. But uh, there are lots of people who don't have that kind of money in the first place, and they're mostly struggling to find information that is both valid, trustable, and explained in a simple kind of way. Because people in finance, people like us, we tend to complicate matters by using big words and jargon and stuff that just confuses the hell out of people. So I thought, it's time to write a book and just kind of speaks to the person in a more simple, easy to understand manner, and just gives everybody a framework on how to kind of build uh, wealth over the longer term. So you. One of the things that I keep talking about is take care of three things. So first thing you want to take care of is your hygiene. And the hygiene is simple. You got to have an insurance policy that takes care of your health. India health insurance is very cheap relative to the US. Um, but and of course, hospital costs are also much lower than the US. Relatively speaking, a family of four would probably be okay with getting a cover that's just about 50, limited to about $15,000 per year, and for that they might pay just of the order of $300. Of course, and as a percentage basis, it's much higher, but $300 per year is all you might need to cover a family of four. Um, it's a relatively small amount, but I think people should take care of that first. You can get private insurance. Your employer does not. You don't have to depend on your employer for insurance. And even if you do, get a private policy anyway because it's relatively cheap. The second thing is you should take care of life insurance. So something happens to you after you die. This is what so something happens to you and you die. Your family needs to be taken care of. So you gotta take care of. Make sure you take care of them. And there's a simple way to calculate how much you need. And the reason why it's different from the US is the US usually has had very low inflation. So you can just take your annual income and multiply it by some 15 or 20 or something like that and say, well, that's the kind of insurance you're going to need. But it's not the same in India because costs keep going up at a much higher level. Our average inflation tends to be between 5 and 7% a year. So, if you were to extrapolate that into the future, what you might think is a lot of money today will not be a lot of money 20, 25 years down the line. So, the calculation factors are a little different. So, I just kind of ironed that out in the book. And then you create something called, I call an emergency fund. This is if you break a leg, you can't go to office, you can't go to work, you're fired from your job, you need at least 6 to 8 months of money in the bank. Put that together, and none of this money should be risked. So it can just be in a equivalent of a CD. We call it an FD, a fixed deposit with a bank, so that you don't kind of risk it in equities or something like that. Then you build wealth by uh, using simple asset allocation. You can choose to directly invest in stocks, which is the most complicated part of things, or you could go down the I will just go and buy a passive mutual fund route. And because in India, interest rates have always been relatively higher, we've actually can make about 6 to 7% a year just on fixed income. So I think everybody should have a mix of fixed income and equities. And here's a simple way to, I've given a kind of a simple way to kind of plan that out. And in the process, introducing how much risk one tends to take. The difference between the fake and the fact point is some of these things are obvious to us, but we tend to make the wrong decisions based on what someone says. So, for instance, someone will come to you and say, "Well, this stock is doubled. I invested something in it, and it's made so much money." Uh, Much of this attracts you to say, "Well, I should also put my money into stocks because then I can double my money." But then most people don't tell you that they put their money in 8 stocks or 10 stocks, and six of them did nothing or went. In fact, they lost a lot of money in them. They want to highlight the one or two that actually did very well. And because they do that, you think that everything you put into the stock market will end up doubling. So you've got to kind of step back and say, well, that's not the case. This is how, and money is made for the most time, it's made in the waiting. You just have to invest and wait while returns come. Mostly you get attracted to people who tell you about how you can make money in 2 months or 3 months and so on. And this is not just in India, it's worldwide. We saw it in the GameStop and AMC sagas in the US. You're seeing we see that all the time in India. But like this, there are lots of other myths as well. They tell you you have to start saving in your 20s in order to get enough money for retirement. And I don't think that's the right way to think of things. Even if you didn't do anything till your 30s, you probably make a lot more money in your 30s than you did in your 20s. And therefore, you have a lot more money to save. In fact, by the time you finished your 30s and your early 40s, you probably finished paying for your house because you've managed to pay down the entire uh, mortgage. And that's when you get some disposable income that allows you to save for a longer time. So even that's a myth that I kind of try. So that like this, there are about 10 or 15 different things that people might tell you, but aren't exactly true, or the actual ways to do things are non-intuitive, and I kind of go through them in the book. I wrote the book primarily because I was telling people this all the time. I had a bunch of articles at capitalmind.in where we talk about each of these things. How credit cards sucker you, or how uh, mutual funds, what's the different ways to evaluate how to select which kind of mutual fund you want, or which kind of what's the kind of stock portfolio you need to build, and so on. I just put that all together and it became a book.
Available on Amazon for those that are curious. Has some great reviews. Everybody here appreciate those that joined. This was to me certainly a very educational conversation. Deepak, appreciate you spending the hour with us. Very thoughtful conversation. I'll have this as a podcast soon enough, and everybody enjoy the rest of your day. I'm doing another space at 5 Eastern, talking about macro, because macro is always a popular area when it comes to spaces. Thank you, Deepak. I do appreciate it.
Thanks so much, Michael, and thanks everyone for listening. Let me know your thoughts.